The perfect time, however, to bring in Kevin Hassett. He is the chairman of the Council of Economic Advisors. And Kevin, I got to start with your reaction to what President Trump said about the Fed. Let's just roll the tape once for the audience, and then get what you make of it.
They're raising interest rates too fast. That's my opinion, but I certainly have confidence. But I think it'll straighten. They're raising interest rates too fast because they think the economy is so good.
All right, that was a more subdued commentary, if you will, from President Trump on the Fed, but we know he is seething. He's tweeted about it. He's voiced his opposition to these rate hikes. What do you make of all of it?
Right. Well, you know, I think that the president is a what you see is what you get kind of guy. And what you just saw in that clip is basically the way he is when we discuss things in the Oval. The president is a genuine, authentic person, and that's what people expect of him. And he's got opinions about the Fed. But, you know, my job at CEA as an economist at the White House is to respect the independence of the Fed and not give them advice. And I think that the president's perspective there, that if the Fed is lifting rates, it's because they think the economy is really solid, is really confirmed in the data. That's, you know, I talk to the president almost every day about what's in the data. And if you look at, you know, Secretary Mnuchin was calling around to the banks a few days ago. If you look at the anecdotal reports, we're looking at probably the best Christmas ever.
Right, like but Kevin, to that point,
the
Kevin,
data are strong.
Kevin,
okay, sure,
I just don't get it, though, because the economy is doing well, but there aren't necessarily signs of inflation. So, I mean, does it bother you at all that they've hiked rates 9 times since President Trump was elected, but they went 126 months without a rate hike under the last couple of presidents until December of 2015? I mean, the Fed can get it wrong because they've got a history of getting it wrong, and why should Main Street pay the price for that?
Right. Well, again, you know, my job is to respect the independence of the Fed, but I agree with you.
But you have opinions, though. You have thoughts about this, though. We're not talking about their independence. Kevin, we're talking about, are they doing the right thing? Are they harming the efforts that the White House is trying to achieve here?
I think that, you know, higher interest rates are, you know, put a drag on the economy for sure. And the Federal Reserve is pursuing a policy that they've described, you know, very well. And I think that if you look at futures markets right now, they're expecting the Fed to pause now at the federal funds futures. But again, my job is not to comment on the specific policies of the Fed. But, you know, markets, you know, of course, our job is to interpret markets, and markets are very much focused on the downside risks for next year. But I would just like to say that, you know, everything we're seeing suggests there are a lot of upside risks that markets should focus on, too. We've got 47 states with unemployment below 5%. We got 32 states with unemployment below 4%. You know, the economy is doing great, and that's showing up in the Christmas sales, which are going to be about the best we've ever seen. And so anyway, so I think that when the markets refocus on the data, then they're going to see that, you know, the risks next year are balanced. There's a lot of upside risk as well.
Right. And again, I don't want you to, I'm not trying to get you to opine on the Fed as much as the idea that, you know, listen, we have back-to-back months where wages went up more than 3%. In fact, this last month, I think, was the first time non-supervisory wages climbed faster than supervisory wages. In other words, the average man and woman on the street who've watched Wall Street make billions of dollars in up or down markets are finally getting a bite at the apple. It should concern you that the Fed could mess all of this up. And when you talk about Wall Street seeing risk, I think the greatest risk that they're seeing is the Fed mismanaging their job. So I don't want you to disrespect the Fed, but you've got to have an opinion on whether, you know, they should hike 2 or 3 more times next year.
Right. You know, my confirmation goes through the Senate Banking Committee. You know, one of the things that every senator asks is that when I'm at the CEA, will I help defend the independence of the Fed? And that's my job. And I've, you know, promised the Senate before confirmation that that's what I would do. But I can say that you're right that, you know, interest rates potentially, if they went too high, could be harmful to the economy. But you have to understand that people who are moving interest rates around are doing that in response to data. And the data are very, very strong, as the president said. So, you know, I think that looking forward to next year, there are a heck of a lot of upside risks. The data are, you know, so think about it. Last year at this time, I came on this show with Stewart and said that growth this year would be about 3.1%. And everybody said, oh, we're crazy. It's going to be in the 2s. And right now, if you look at the growth forecast for next year, we're once again at 3%. And a lot of people are closer to us than they were last year. And I'm just saying that I think we're going to see a repeat, that the data continue to be strong, that there's a lot of momentum going into next year.
Everyone applauds the efforts that this White House has taken on taxes, on regulations. I applaud what the White House is doing on China. I think it's about time someone faced down China and got a fair deal. But I don't see how you could be so sanguine knowing that the Fed can unravel all of this with some miscues. But I'll leave it at that.